We're so happy. We are so happy to see you all here at ShowFx World International webinar with Alistair Crooks. The topic today is Ali's 4 pillars of successful Forex trading. And we're so happy to see you all here. And my name is Anna. I'm one of the organizers of ShowFx World events, and I'll be your host for tonight. Before we start, let me just tell you a few words about ShowFx World. So we have been organizing financial conferences and webinars and expos for traders since 2009. We've been organizing events all around the world, in Asia, in Europe. So probably some of you have already been to our live events, to our conferences. If yes, please let us know in the chat. We have been engaging top speakers, both local speakers, international speakers. The main thing is that those are the people who could really help you benefit from the knowledge and help you trade better and help you improve your real trading results. And on each of our events, we also do the prize draws. We give away different prizes, and our events are free. It has always been like that. But since last year, due to the pandemic, we have shifted to Mars. Our main focus is Malaysia and Malaysian audience. For Malaysians, we have been organizing webinars every 2 weeks. But sometimes we organize international webinars as well, like this one. And for international webinars, we draw people from all around the world. So please check our Facebook pages, and I recommend you to follow us, to subscribe to our Facebook pages. Let me do the demonstration of the screen so I could show you. So as you can see here, ShowFx World Online is our international page for international events. And this one is our page. We'll drop you links into the chat so you could subscribe. So please subscribe in order not to miss our future events, okay? And so now for today, just let me go back. I would like to mention our general sponsor. Our general sponsor of the webinars is Instaforex. It's a global broker with over 7 million clients worldwide and over 40 international awards. Can you imagine that? So today we have prepared for you a whole variety of information, of bonuses, all from Instaforex, and also the representative of Instaforex, Mr. Pavel, will talk today after Alistair's presentation, and he will tell you a bit more about the company and the company's services. And for all of you, I have some happy news. So today, any of you can get a 50, 70, 80, 90, or $100 trading bonus. Nothing is needed for that. Just the fact that you are here is enough. So in the middle of Alistair's presentation, there will be a lucky draw. And so 5 of you will be the lucky winners and get these trading bonuses. And also, of course, for those who stay with us till the end of the webinar, we will have our super quiz. And many of you probably know about this. Many of you who already visited our webinars know that super quiz is your chance, based on your knowledge, to win $1,000 US, $2,000 US trading bonuses, or iPhone SE. So please stay till the end and don't miss it. All that will be waiting for you tonight. One last thing before I introduce you to our speaker tonight is, please, in your chat, guys, put the settings so that you could write to all participants and panelists. Okay, there's an option in the chat. When you write a message, you can write it either to panelists or speakers only, or to everybody. Please make sure you make the setting so that you write to everybody. everyone, okay? Because it's important, especially during the super quiz. And that is probably all from me for now. And now I would like you to introduce Mr. Alistair Crooks, who has already been a speaker at our events, and he's one of the most renowned and most welcomed speakers and traders. He has over 20 years of trading experience, and he's the head of Traders Support Club in UK. They have live trading rooms, and he has a lot of real trading experience that he can share with you tonight. So please welcome Alistair Crooks. Alistair, are you here?
I'm here. How are we doing, Anna? Are we good?
Great, great.
Okay,
we're happy to see you here.
It's good to be here. Right. I'm going to do a little check with everybody to make sure that we are all seeing the same thing. Just give me a yes in the box if you can see my screen, everybody. It's great to see you. It's great to see so many of you here today. So you should be able to see my screen. Good, good. Now, obviously, in the next 90 minutes we've got a little break in the middle. I'm not going to be able to teach you everything I can possibly know from the last 20 years, the ups, the downs, and everything. But I'm going to try and distill as much as possible. I am going to go through one of the strategies that we trade, and I'm also going to show you a process that we do with our traders in our room. This is something we do with our traders both one-on-one and in our room on how to build off the back of that strategy. So you're going to get something today that I've never done with the ShowFx World Group before. So that will come just before the break. So make sure you stay tuned for that. But what I want to make sure as well that you understand that today is not just about a strategy. If you're one of those people that goes from event to event to try and pick up strategies but are not getting the success you want, then it clearly tells you that that's not what it's all about. So it's important to understand that today is not just about the strategy that I'm going to show you. It is also about what I'm going to teach you in each area of trading, because that's the key bit. So what I'm not going to do, because there's so many of you here, I'm not going to be able to take questions in terms of a conversation. So if you post in the box that you can't hear, or that you asking a question as I'm going to miss that. But what we are going to do is we will have questions at the end of section 1, and we will have questions at the end of section 2. So there's anything that you want answering as I'm going through the material, make a note of it, and then I will answer all of those questions before the break on everything we do up to the break, and then after. All right, so make sure you're set like that. So remember, I'm going to be showing you some previous live trade examples. I'm going to be going through a strategy. Anything that I show you is for educational purposes only. Please make sure that you do your own risk and your own testing and your own examination of anything that I show you. All right, so everybody should be able to see my screen. Give me a yes if you can see my screen, guys. Yep. Okay. So anybody that's having problems, the panelists will do what they can to help you. But yep, I'm good to go. So before we get into the detail, just a little bit about me. Some of you, I can even see some of the names I've recognized from previous events that I've done. But I've been in this game now for 20 years. I think it's important to understand that I was a trader first, educator second. There are a lot of people out there that do it the other way around. But I learned to trade before I ever learned to teach. Traders Support Club's been around for nearly 12 years, but I've been trading for 20. I'm one of only 2 traders back in 2018 that was willing to trade their money live at the London Forex Expo. And I think it's most important to understand that I am not going around doing lots and lots of events. I only tend to do things for ShowFx World and what I do for Traders Support Club. My priority and where I spend my time is in my swing trading room. I'm working with students, a group of students every week, probably about 9 to 10 hours a week where I'm working with them. And we also have 2 day trading rooms as well. So not only am I trading live in front of these guys, I'm also reviewing their live trades, and they're seeing the ups, they're seeing the downs, they're seeing how I do it. But also during that period, I've learned a lot about how traders work. Simple example would be you have some traders that have a huge amount of knowledge and will die out on that knowledge and tell everybody what they know, but they can't execute what it is they know. And then you have the other side, you have a lot of people that don't really have the knowledge, but actually have got a very good mindset. So to be a successful trader, it's a combination of the two. And I spend a lot of my time not just teaching people things, but what I'm doing is actually helping them better their performance and become better traders. And again, it's not just me. You can see there, we've got a couple of other trainers. There's Kerry down the bottom and Martin in the middle. So these guys are both TSC students, and they help me coach other people within the group. And we're not a big training organization. I've purposely made it that way so that the people we work with, we can give them our time and attention. So if you're really serious and you want to work with us more closely, I will give you an opportunity later where you can become a free member, and everybody can do that. You can all become a free member of our community, but then there'll be the opportunity to work with us. So the big subject of today is my 4 pillars of trading. But before I get into this, every presentation I do, I start with this particular area, because one of the things that I see so much is traders falling into certain traps. And like they may have a lot of knowledge, they may know a lot about trading, they may have been to a lot of events. They often fall into one of these 3 areas. So I always highlight these 3 areas when I'm doing this. And the first one that I want to talk about to you guys is what I call the information trap. So the information trap is where people are accumulating information, as I've said, but they're not actually putting it into a process. And what they're not doing is making it work in a systematic way that they can test and prove. And the challenge, one of the big challenges with this is YouTube. Now, I'm not going to sit here and say that there isn't good information out there on YouTube, but part of the challenge is being able to understand the context. So for example, you might learn a specific tool or strategy or concept, but that strategy or concept might be relevant to the trader that's teaching it. So the challenge is you don't necessarily know the context by which that comes in or how you can actually deploy it. The next one is feedback. One of the challenges traders will have if they're learning off YouTube and they're learning off the internet is very often they can't get feedback. So the challenge there is they'll not know specifically if what it is they're learning when they try and deploy it into the market, whether or not it's actually working. And I've worked with traders, and I get the call often from traders 2, 3, or 4 years down the line, where the big thing they keep saying is, I've got all this knowledge and I've accumulated all this information, but I'm not able to actually deploy it successfully into the markets. And it's usually because they're not doing one of the 4 things I'm going to talk about as we go through today. And free can be good, but as I've said there, it's not always good enough. And part of that is because you don't get the feedback and you're not able to really quantify what it is you're doing. Another one is this, and this is something that I see. Now, I'm not against indicators, and I'm not against people using indicators or doing different things within their trading. But one of the challenges I see is people come in with either too many indicators, they're using too many tools, too many indicators. They're overly concerned by which indicator is the best indicator, when actually what they should be thinking about is whether or not the indicator is appropriate for what they're doing. But often the mindset is, well, the next indicator or the next strategy is going to be the thing that saves you. So what they end up doing is they're blaming people from an external point of view. So what they're doing is they're thinking that the solution is outside themselves. It's the next piece of knowledge. It's the next piece of strategy. Well, as I've said, for 12 years, I've been working with people one-on-one, and nearly every time, even if their process or the indicators they're using needs changing, 9 times out of 10, it's a mindset issue that needs work as well. Very rarely have people got their trading mindset absolutely spot on. So it's really important to understand that. And a lot of indicators, not all, but a lot of indicators and concepts are designed to come across in a very complex way. And as a result of that, it can seem to the person looking at it and using it that it's somehow better. Now, some complex indicators work well, some simple indicators work well. What's more important is how you're using them, okay? So don't be fooled by the fact that just because something is more complex or comes across more complex, that it's got a greater chance of working. Remember, most indicators are just another form of price. You have studies on the top of the chart, as many of you will know, and then you've got indicators below the chart. But often they're just a form of price. And if you're not prioritizing the price action with what you do and relying too much on indicators, then you're looking too external for the solution. And most traders have not either tested the indicators they are using in either previous historical market conditions or in the current live conditions. And as a result, they're not able to quantify the effectiveness of it. And I hear things like people saying, moving averages don't work or volume doesn't work. And very often what people are doing is they are creating a broad assumption about something when in fact they're either using the indicator incorrectly or they're not quantifying what they mean by it doesn't work. Too many traders think an indicator needs to work 90% of the time for it to be effective. Well, you'll see later that doesn't have to be the case. And as it says there, it helps kind of, well, it pushes along this idea of what we call Holy Grail mentality. Has anybody here heard of that in trading? The Holy Grail mentality? Give me a yes if you've heard that in the box, that the next indicator, the next strategy is going to be the one. Yeah. So it's a phrase that often comes up and it's been thrown around for years. And too many traders are jumping for the next thing, 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 thinking this one is going to be the answer to all their prayers. Okay. Now, last one I want to talk about before we get into my 4 pillars is this. I hear often and often and often that people will blame the broker. So what they'll end up doing is they'll blame the broker for something that is going wrong. So they'll say things like that, my broker's got bad spreads, or the execution is poor, they keep slipping me, I need a better broker. Well, today you're going to get an opportunity to work with a great broker. So don't miss out on that, but don't let the broker be your excuse. I trade with a great broker, but if my broker wasn't as good, I'd still be able to be successful. So the broker is not the defining factor, and the broker is not out to get you. This is a big thing in terms of stop hunting. Stop hunting occurs, but the broker is not out there to get you. So lose that as an excuse. And the reason a lot of traders are using the excuses or are falling foul to the traps that I've just told you about is because they are not following and not using and applying each of the 4 pillars that we teach and we use at Traders Support Club. And I want to go through these because it's really important you have an understanding of what these are. So the first one that we teach is what we call discretion and strategy. So this is essentially all of the technical analysis that you will do. So your technical analysis, it will be the process by which you create a strategy, which we're going to go through in a second. So your strategy criteria, and it will also be what we call overall market conditions. And these factors will all make up how good you are at deploying and basically analyzing the market, number one, and then deploying your strategy. All right. So strategy and discretion, or discretion and strategy, whichever way you want to do it. That is pillar 1. Now, pillar 2 is, we call it data analysis. And what we talk about in our trading room is data deployment. Now, what we mean by that is your ability to analyze and record the data of your back-tested trades, your live trades, and then your ability to not only accumulate that data, but your ability to review that data and optimize that data. And this is a big one that traders are not doing. I'm sure there's some of you here that know that your record keeping and the quality of the data that you are recording about your trades probably needs work. Yet these are very often the area that is falling down, yet people are blaming something else. They're blaming the indicator, they're blaming the strategy. And then third on the list is risk management. Okay. So this is just more than using a stop or making sure that you have a limit order or sticking to your trading plan. This is making sure that you're right risk percentage relative to the trade frequency. This also is in making sure that you use stops, but you only move stops if you know statistically that is in your favor to do. How many of you here have moved stops on your trade, and you've done it purely out of fear because you want to get your stop to break even or lock in profit? Has anyone here done that? Yeah. So you probably haven't got a systematic approach for doing that. Would that be fair? You haven't bothered to take the time to work out whether or not statistically that is the appropriate time to move your stop. Yeah. So if you're moving stops without doing that, then essentially you could be actually hindering the effectiveness of your strategy just because you want the relief or the short-term relief of having a trade at break even. So simply moving stops to break even is not necessarily the right thing to do. Lastly, so we'll look at the last one here, mindset. So the last one is mindset. Now this covers a range of different things. Now I spend a lot of time, as I've said, working on traders' mindset, not because I just enjoy it, but because that's the area where traders need help. This includes things like recency bias. It includes, bear with me 1 second. There we go, recency bias. It also includes personality styles, which we're going to touch on today. We're going to talk about both of these, and accountability and feedback. So where are you accountable for what it is you do and how you trade, and where are you getting feedback? So we're going to aim today to do our best to cover as much as I can in each of these areas. I will elaborate on moving stops when we get there. Mano, remember, I'm not going to be answering questions as I go. Keep your questions, and then I'll cover them when we get to the end of each section. All right, because I've got so much that I want to cover. So keep your question held, and then I can elaborate it at the right time. So remember to ask that either at the end or the end of section 1. So I want to do my best to go through this as much of this as I possibly can. But remember, I'm not going to be able to teach you this all in one go. So at the end, I'm going to give you a link so you can access free training material. I do quarterly webinars for free where I go through one of these pillars in more detail. And we also have trainings that work and help you work in this area as well. Now, before we do that, I want you to think about these 4 pillars slightly differently. So the challenge most traders have is that they will be spending more time on one of the 4 pillars. So think of them like a leg on a table. So let's imagine this leg here is your discretionary analysis and your strategies. So imagine that being the leg. So that's pillar 1. Over here, we've got data. I'm going to draw this in a different color so you can see it. So here we got discretion and strategy. Over here, we've got data. Back here, we've got risk management. And then here we've got mindset. So if a trader has got all these legs in place, the table is solid. But what most traders underestimate is how much your risk management will affect your mindset, and vice versa. How much your mindset will affect your risk management. Unless you're following a process with your strategy, that can affect your mindset. It's easy to have a run of losers if you know that the strategy you're following has losers, but also has winning runs as well. The amount of data you have is going to affect that. So the amount of data that you have about your strategy will affect how well you execute on that. Again, like I talked about stops, moving stops without actually knowing whether it's the right thing to do is affected by the data. So can everybody see? Just give me a yes if you can see that each of these 4 pillars is affected by the other pillar. Can you see that? So what that means is if you're missing one of these, or you're not putting enough energy and focus on it, all that has to happen if one of these legs is missing or weak is your trading might go well for a while because you've hit in a winning run and everything's good. But what happens if you start to apply pressure to the table and one of the legs is weak, guys? So what happens if you apply pressure to the table and one of the legs is weak, or worse, you're not paying any attention to that? The leg doesn't even exist. Exactly, it breaks. And this is exactly what happens to traders over and over again. They start out with a new strategy. They do a little bit of work on their mindset. Their risk is okay, but they don't bother recording their data. So things go all right for a bit, and then when the pressure comes on, the table collapses. So every trader is going to go through periods of trading pressure. Who's experienced that? So a losing run or a quiet period where you're not had, it doesn't change. So I've been trading 20 years. I still have periods like this. Does that make sense to everyone? Give me a yes if you're following me. But there's often this illusion in this industry that the guys who have been doing this really a long time and are successful don't experience pressure or never have losing runs. It couldn't be further from the truth. So the key thing is when I go through those periods, all the legs, data, discretion, strategy, risk management, mindset, they're all on point. I can see how they affect each other. And once you've got all 4 in place, if you can see that one is weak, or you go to your data to do the analysis, that will have a beneficial effect on all the others. if you know that your strategy over a 5 to 10 year period, if you've got the data, if you haven't, you should have, if you know that it's a swing strategy, every single year, it will have at least 1 6 trade losing run and probably 3 to 4 3 trade losing runs. If that then happens to you because you've got the right data, you're not going to suddenly change what you're doing and change your strategy and change your approach or change your risk. And what that does is that helps you maintain, because too many traders either give up too soon, change their strategy, question what they're doing. So start thinking about these pillars in this concept of tables, legs on a table, because this will make a huge difference to what you do. Okay, so let's look at the first one. So what I want to do is spend about 15, 20 minutes just going through the concepts of strategy and discretion. Most of you, if you've traded before, will have either been focusing primarily on discretion or strategy. You may not have even been aware that you've been doing it, but I'm going to show you how to marry the two. And then I'm going to finish going through one of the strategies that our swing traders use. I'll show you the stats over the last 8 years. And then what I'll do is I'll show you how you can build on that strategy if you want to increase trade frequency, and if you want to actually optimize the strategy. And I'll show you the process in as much detail as I can in 15, 20 minutes. You guys up for that? Good. So let's go with the definition of what we call discretion. So discretion by normal definition is being able to do what you want. So most of you will have used discretion at some point. You will have got out of a trade too soon. You may have not waited for all your criteria to set up and got in the trade. One day you might have used a trend line to determine whether or not the market is going to continue up. You might have used a support and resistance line the other day. Then you might have used volume. So you will have probably had either a discretionary approach that is different every time, or you would have added in discretion at some point. The way that we define discretion is relating to your analysis. So it's the analysis you do, and this is the key word, it's the analysis you do before you wait for the strategy to set up. My first trading mentor from the States said, every single trade you place, Ali, should feel like it's landed in your lap. And what I mean by that is every trade should feel like it comes to you. Give me a yes if that concept makes sense. So it should feel like the trade comes to you, that you're not chasing the trade, you're not chasing the market. So the way that we do that, and the way that we teach our students to do that, is what they've got to do first is identify where that market is specifically. Is it in a with the trend condition? Is it in a against the trend condition? Or our third option is a trend line break. And I'm going to explain the parameters by which you do this. Now, unfortunately, today, this isn't something I can teach you and go through and get you to practice. But at our free webinars, we do this. And those of you that come and work with me in the trading room, we do this on a daily and a weekly basis. And this is not something I teach and not do. This is something I'm doing 3 or 4 times a week. Is I'm going through my watch list and I'm establishing which trades are in which market condition. So I use a very simple process. I'm a big fan, and I know the traders that I work with and the traders I've learned from go with this process, which is using higher time frames. Now, this doesn't matter whether you trade as a swing trader and you trade mostly on the 4-hour or the daily, you still will look at the higher time frames. It doesn't matter if you're a day trader and you're working on the lower time frames. So the first thing I'm going to do in any scenario is I am going to determine where my support and resistance levels are. Now, I hear all sorts of things out there. People message me saying support and resistance doesn't work. Well, define doesn't work. For me, support and resistance doesn't have to work 80% of the time. It only has to work just over 50. And I'm using it to frame the market. I don't trade off a support and resistance level. I'm using it to frame the market so I can get an idea of where that market is. I will use trend lines. We have a very, very specific process by which we draw and set up trend lines. So it can be evaluated, and we know that every trend line is not guesswork. We use a specific process to do it. So then what we will do as a result of looking at that market, simply using price analysis with support and resistance, trend line, we will use, and we will also look at where the momentum is of those, and we'll look at the clean air on a market. On our Kickstart training, we teach you the exact process of how you combine all of these. And the ultimate reason we do that is we're looking to define the market position. Now, we either call this the overall market position, because you might not be able to define it specifically at that point, or the other term that we have is the specific market position. So the three market positions that we are looking for are with the trend, against the trend, and then the last one we look for is what is called a trend line break. So these are the three that we use. Now, really, the trend line break, if you could only, or let me ask you guys, how many have heard of the concept of with the trend and against the trend? It's not something new. I don't claim it to be mine, but it's a concept that we use. What we do have is a very specific process to determine that. And actually, the trend line break, you could actually fit that into the against the trend. If you could only have against the trend and with the trend line break would go in there. But this is something specific that we use when the market is in a certain condition. So the first thing we want to do is identify that, and then we will choose the appropriate strategy depending on where that market is at that time. So as it says there, then choose the strategy that fits the overall or the specific market position. So what I won't do is, if the market is trending up and it's clearly in a with the trend scenario, and I'm simplifying this, but in a with the trend scenario, I'm not going to try and attempt to go against the trend, even though there are periods where that market is declining. I'm going to look and make sure that I am at a specific support and resistance level. And again, that doesn't mean I will suddenly jump in and trade at that point, but what I will do is make sure that I am only considering against the trend setups if we're at key levels of support and resistance, and only considering with the trend setups if we are in between those levels. Certain criteria will have to happen. And then the last one is our trend line break condition, but that's very specific, something we only teach once you get in with us at the total trader level. So if I'm in no man's land, or the market relative to what I'm trading, as it says there, is choppy, then I simply will move on and bypass that market. So all I'm doing with my main watch list, and these are all the watch lists that I will look at. I don't trade every single one of these, but I will watch most of these. Most of these are in my trading watch list. I'm literally going through that list and I'm looking for which of these are in any of these three conditions. I'm not looking at Aussie CAD and saying, right, can I trade it? I am looking very specifically, and then I will move my trades from that watch list into the specific strategy for that particular condition. So currently you'll see, this is live real time now. These are the markets up the top that I've got for a potential against the trend. Doesn't mean I'm looking to trade it right now. I'm watching it. So oil, you can see we're looking at that getting to a resistance at the moment. Then I've got two lots of strategies for trend line breaks. And then here we've got actually live at the moment, one here, and live already on oil. These are the ones that are with the trend. So at the moment, oil is actually in a with the trend market as a live setup, but could end up being an against the trend setup if it reacts to the resistance level at that point. All right. So that's the key thing there. I'm not doing this process to place the trades. I am simply doing this process to make sure that the markets that I want to trade are in the right condition. Any questions about this, I will go through once we've been through the strategy, because I want to get to the strategy so you guys can see this. So what is a strategy? As we define it, a strategy is a set of technical criteria that have been tested and proven to give you an edge over a specific period of time in a specific overall market condition. Now, this is very important. The strategy criteria are repeatable. This is the key word. So they are the same every time. I will not change these. I will not stray from these. So once the market is in the appropriate market condition, so let's say it's a with the trend setup here. Once it's in the appropriate condition, appropriate area, I will then wait for the criteria to be met. And I'm actually going to give you the criteria of one of our strategies in a second, because it's been proven and it works. But what I'm not going to do is stray from that. So once I'm happy with market, let's say it was pound US dollar. Once I'm happy with that, I then wait. and I wait for each of these criteria to come along. And this is the concept of me waiting for the trade to land in my lap, where I'm looking for those criteria. So the criteria I'm going to give you today, as I said right at the start, they come with a disclaimer, because those criteria don't work every single time that trade sets up. Those criteria work if the market is in the right condition. Okay, so we're going to go through this step by step. So before we get to that strategy and the actual criteria for that strategy, what I want to do is just show you some of the results. Would you guys like to see the results over the last 8 years? And this is just one of the 6 swing strategies that we trade. Okay, so what I'm going to do is just show you here. So if I go in here and just show you this. So if I go to the data tab, you'll notice here are all of the trades over the last 6 years. Now, these are trades that we call in the trading room. We discuss them. I don't tell people where to buy, but here's the list of all of those trades. Now, this is swing trading. So what you'll notice is if we go to the summary, there's only 2.5 trades a month. Now, for most of you, who would agree that's not enough trades? You'd want more trades than 2.5 a month. I would want ideally more than that. But here's what's really important. On a compounded return, it's over 100%. Midway, about 60. Okay. Now look, it's got a win-loss ratio of 61%. Its longest winning run is 7. Its longest losing run is 3. And it's got a trade expectancy of almost 1% per trade, regardless of whether it's a winner or a loser. However, we're going to go through the criteria so that you can go away and use that. But what's really important is I'm going to show you how you can optimize that using the process that we teach. All right. So remember, this is only one strategy out of the 6 that our swing traders will trade. But again, it's still a profitable setup. So the criteria are as follows. So let me just clear this off and I'll give you the criteria. Now, you don't have to worry about writing these criteria down, because what I'm going to do is I'm going to pop a little PDF into the chat box, and I'll make sure that Anna gets this so that she can email it to you as well. So you have the criteria in front of you. I'll come to max drawdowns later, Faisal. I'll come to that in a bit. So I'll talk about max drawdowns after the break. So at the moment, I want you to think about the fact that we're only working with the criteria. We'll get to data, risk management, and drawdowns very soon. So here's the criteria. I'm not going to go through all of these steps, but I'm not going to read these out. I'm going to show you the criteria on the screen because it's much easier to see. So this is the important bit. This is a with the trend strategy. So the market needs to be in with the trend conditions. Very simply, the market needs to be in between key levels of support and resistance. And for a long setup, as you can see here, price needs to make a clear new high. So once you've established that this is a with the trend condition on this particular market at this particular time, then what you're looking for is the criteria to set up. So you can see here, price must be above the daily 50 moving average, and you wait for price to pull back to the blue moving average there, which is the 21 period moving average right there. Price must create a positive, what DCC stands for is a directional candle close. So a directional candle close is closing in the direction that I want, and it's closing positive, which is this candle here. So you can see there's the close of the DCC candle. And then very simply, all I'm looking to do is enter the trade on a break of the high of that candle with my stop below the candle that has created the lowest point since the 21 moving average has been hit. And then what I'm looking for is I'm looking for a clean air, which is the room between where this high is up to the next resistance. I'm looking for a clean air from the entry to that resistance of 2 to 1, which you can see there. So straight away, you can see on this trade, here is my risk. So my risk on the trade is from the entry down to the low where my stop would go. And then my with the trend setup, my target is there. Hold your questions until, guys, I can't go through and look at the chat and answer questions. Keep all your questions until I get to the end of this section, and then I will answer them. All right, please stop. Otherwise, we won't be able to do this. I can't focus on two things at once. I try, but I can't. So hold your questions until we get to the questions bit. So let me go through this again. Price has to make a clear new high in a with the trend condition. Price has to pull back to the 21 moving average, and then it has to create a positive directional candle close, which is this one here. If it doesn't do that, I don't enter the trade. Then I look to get in. My entry is 1 point above the high, stop, can either be at or 1 point below the low, it's up to you. And then you enter the trade, and then as long as there is a ratio of 2 to 1 clean air relative to your risk. Now it's important. Some trades, your directional candle close will be smaller. It must close above the 21 moving average, but it might be smaller. If the candle becomes smaller, so the candle look like this, then the ratio of 2 to 1 means your stop would be earlier. All right. Now, some of our traders will have tested this strategy to run it up to the next criteria, next support and resistance. But we know solidly based on the back testing and live data that a 2 to 1 trade works and gives you a positive edge with that particular strategy. Okay. So the same conditions are applied for a short. And if you look in the chat box, what I've done is I've given you the PDF so you can go through the strategy in detail, and Anna will make sure that you get a copy of that. All right. So that's the specific strategy criteria. Now, as I've already said, you're in a position where this is a swing-based strategy, and it's one of 6 that our swing traders trade. Now, at 2.5 trades a month, it's probably not giving you a high enough trade frequency. So what I'm going to talk about now is how you can potentially optimize the strategy, and then use what I'm going to teach you after the break, your data analysis, to test whether or not that strategy is going to work. And this is what a lot of our members are doing right now. So if we think about it, we're trading this setup on the daily chart. Okay. Now the setup works on lower time frames, but we're trading this setup on the daily time frame. So we're trading it on the daily time frame. Now, when I trade this on the daily time frame, I know statistically it's giving me 2.5 trades a month. So what I'm looking to do is optimize that strategy. And the way I optimize the strategy is very simple. Trade frequency, win-loss ratio, and risk to reward. So when I'm working closely with a trader, these are the 3 areas. If they're looking to optimize and increase the return of the strategy they're trading, then what we're not going to do is just simply try and make all 3 of these better. The challenge a lot of traders do is they look at the results they're getting and they want better results. So who here wants better results? Just give me a yes in the box. It doesn't matter whether you're currently losing or whether you are making money. Everybody wants better results. So optimization is something that naturally traders are going to do, but also it's a really good thing to be doing even if you're doing well, because market conditions can change, and keeping on top of what's happening in the market is very important. But let's say you're looking at this and you're saying, I would like to make more money from this strategy, and I know that it only has 2.5 trades a month. Well, so what I'm going to look at is ways to increase the trade frequency. I'm not going to straight away go and say, right, can I increase trade frequency? Can I increase risk to reward? Or can I increase win-loss? I'm going to look at increasing trade frequency. But I know that the strategy is working at a 2 to 1 basis. Well, what if the strategy could also work with a higher risk to reward? Could I change the entry on this particular strategy to increase the risk to reward? Because if I keep the trade frequency the same, but increase the risk to reward, and it has minimal impact on my win-loss, my results go up. If I am in a situation where I can increase trade frequency, my risk to reward stays the same and my win-loss stays pretty much the same, my results go up. So what I'm not looking to do, too many traders are hell-bent, are set on trying to increase their win-loss ratio. That's probably the last place I'm going to go. I'm going to look at my trade frequency, and I'm going to look at risk to reward. That's going to be the key thing that I look at. So how do I go about doing that? Let's go and have a little look at an example of what we've done here. So what I'm going to do is, the first thing I'm going to look at is I'm going to look at risk to reward. So we're going to have a look at a couple of scenarios where the trade setup has come along. And we're going to look and see how, by using a lower time frame, you can increase risk to reward. So this is something that we're testing at the moment. So you take the original strategy. I'll just move this forward so you can see it. So you take the original strategy and you look to see if there are other concepts, other entries that you can use that are going to increase the probability of that trade coming along, okay, on that trade being a successful one. So what I'm going to do is I'm going to show you an example here. So here's an example of that particular trade setup. Okay, so price makes a new high, comes down, pulls back. So there's an example of the trade setup. Now, the challenge with this trade setup is what you will have seen is there is a resistance level that means either getting a 2-to-1 is going to be difficult on this trade. So you can see there. So either getting a 2-to-1 is going to be difficult, or you're not going to take the trade because you don't want to trade with the trend into a resistance. So if we go back and we just look at the same scenario, I'm going to give you some things that you can look at that will help you. Now, I'll need to go further back on this one. This will take me a little while to get there. Then I'm going to explain how this works. So 3rd of March, there's the standard trade. So what you're waiting for is this criteria. But what you can do is drop to a lower time frame. So to go to a lower time frame, what you would do is choose a time frame that you know you would be able to trade, or that you could use a robot to add into. So the time frame that we will go to is a 60-minute. So the standard entry on this strategy is on the daily, but we're going to a lower time frame and we're going down to the 60-minute. Give me a yes if that makes sense. So rather than wait for the trade to set up on the hourly, when we reach a certain element of it, we're going to go down to the 60. So we wait for price to create a new high, and we wait for price to pull back to the 21 moving average. So that's the first 2 criteria of the strategy. Number 1, new high, pull back to the 21. And then what we will do once that occurs is, rather than wait for the directional candle to close, what we'll do is, on the 60-minute chart, we will wait for one candle to close above the 50 moving average, which is the orange moving average you can see in there, right there. So what that means is we're getting into the trade on a lower time frame and we're getting in earlier. So this particular candle here is getting in once the daily chart has reached the 21, but rather than waiting for this directional candle to close, which means you would be getting in all the way up here, and I'll just configure this so you can see it on the lower time frame. So rather than waiting all this time and getting in when price gets to here, what you end up doing is you end up getting in much earlier. You get in here once the first candle on the hourly chart closes above the 50 moving average, which you can see here. You've got a positive candle close and it closes above the 50 moving average. And then rather than your stop going below the lowest point, if there has been a higher low, you tuck your stop in there. So what you end up with is you end up with a tighter trade. So what you'll see is the same trade over here. And if I draw the trade out again, so the same trade over here that would set up on the daily chart, and based on where that resistance is, it's likely you wouldn't be able to take the trade because it doesn't do a minimum of 2-to-1. On the hourly chart, you've got a 4-to-1 ratio trade before you get to the resistance. So what you're doing is you're using 2 of the criteria for the daily setup, and you're combining that with criteria on the 60. So you take the proven strategy that works and say, well, okay, I could either one, keep trading that, or two, I can look to optimize it using the rules that I've just shown you. But the challenge when you optimize like this is you've got to remember that there are three elements that you're looking at. You're looking at trade frequency, win-loss ratio, and risk to reward. So primarily with this option, you are potentially increasing trade frequency, but the one that you are increasing first and foremost on as many, not every trade, but on a large percentage of those, is you're increasing the risk to reward. So this example, on this trade, on the daily chart, you wouldn't trade it because you can't get a 2-to-1 before the resistance. There's not enough clean air. So this would be a no trade. But on the 60-minute chart, you would trade this because you can trade a 4-to-1 before you get up to the resistance. So what you end up with in this one example is an increase in trade frequency, trade here, but no trade here, and an increase in risk to reward because you've got a 4-to-1 here, but because it's not big enough over there to get the trade, there is no trade. So all you have to do, and you'll see this after the break, is you have to go away and test the response of optimizing on a lower time frame. So we know the detail of this, and we know how much it impacts your win-loss. We know how much it impacts your trade frequency. So what it does is it gives you more trades. It gives you a better risk to reward, but it does affect the win-loss ratio a little bit. So you go from a 60% win-loss ratio, you then go down to a lower. So it actually drops close to 50%. So it reduces the win-loss ratio, but our traders are happy to pay that price because they're getting lots more trades and they're getting a better risk to reward. All right. So I'm sure I'm now going to get a ton of questions about this. So I'm sure there's going to be plenty of questions. So before we go to a break, guys, I'm going to take as many of those as I possibly can because I'm sure there's questions on the strategy itself. So I'm going to try and do that, as I know there's a lot of you here, and I'll try and get as many of those questions answered. The criteria for the daily are there, and I will run through the 60-minute criteria here. So I'll do that, and then I'll start taking your questions. So once price makes a new high and pulls back to the daily 21 moving average, you then go down to a 60-minute chart, and you trade off the first candle that closes above the 50 moving average on that 60-minute chart. And your stop will go under the most recent low. Okay, I've dropped a PDF in there. Well, we'll make sure that Anna sends you that tomorrow if you can't see it. No, so it's not a combination of moving average cross, okay? I'm not interested in the moving average cross on the 60-minute. All I'm concerned about, if I go all I'm concerned about, I'll go back to the example. Bear with me a second. All I'm concerned about is price closing positively above the weekly 50. So if we circle the two areas here, so everybody can see it. So that would be where the standard trade, you'd be waiting for the standard trade here. So you'd be waiting for the standard trade. The standard strategy is profitable and successful. But if you want to optimize it, and the 21 moving average is hit, you then go down to the 60-minute chart. And on the 60-minute chart, you wait for your first 60-minute candle to close positively above the 50 moving average. It doesn't if the moving averages haven't crossed. Okay, so it doesn't matter if the moving averages haven't crossed. Okay, if there's no PDF, don't worry. Anna will send that out to you on an email tomorrow. Just give me a yes, guys, if you get that. If you can't see the PDF in the chat, just let me know. Yep. So don't panic. Okay, another question. How do I identify whether price is in a with the trend condition? Really good question. So let me come back to that. Let me just get my slides back up so you can see this, because it's easier to draw this. Bear with me 2 seconds, everyone. So very simply, the market can only be, and I can't give you, I've only got a short time to answer this, but I can give you the basics. Markets are only going up or down, or as you can see there, sideways. So markets will move in very specific ways, up, down, or sideways. Yes, there'll be times when price consolidates around a resistance or consolidates in the middle, but what you have is ultimately a market moving in between levels, either up or down, or deciding to break those levels and then moving up to the next level. So with the trend condition is where the market is in between key levels of support and resistance that you've identified. So it's in between key levels of support and resistance. And price, if it's trending up, is very simply making clear higher highs. Now, you may have a scenario where price does something like this, and there's a big area of support. So you might have a scenario like that, that it makes a higher high around that level, and it is with the trend, but you choose not to take it until it's past those prior support points. Okay, so it might be that you have some interim support points. So it's when price is in between two key levels relative to the time that you trade, and there is enough clean air for you to be able to take the trade at the appropriate risk to reward. So on this strategy, you need to have a clear 2-to-1. So you have to be able to make twice as much as you're going to risk. Okay. So that's how you identify whether a market is in a with the trend condition. You can use moving averages to do that. Okay, guys, I'm going to say this one more time. Okay. I'm going to say this one more time. You are going to get a recording and you will get the PDF of the criteria. Please stop asking. Okay. Because you're filling up the chat box and I'm going to miss helping people. You're going to get the recording and you're going to get a PDF. All right. We're not going to answer that question again. Okay, guys, any questions about the strategy? With regards to moving averages, personally, there's always a lot of debate about moving averages. I use the simple 21 moving average. I use the simple 50 moving average. Both of these are set to close. So both of these are set to close. I will use the 200 moving average for targets. So I don't tend to trade off the 200 moving average, but I'll use it as targets and potentially combined with support and resistance areas. And then I use two other moving averages. I use an exponential 5 high and an exponential 5 low. So if we go back to the chart, so I can show you that. So if we go back to the chart and we zoom in here, and I'll take you all the way forward to here, because this is actually another way that you can optimize this strategy. So you'll notice here's my 21 moving average in blue. That's simple. You can see it set up there. Here's my 50 moving average there. And also my 5 high and my 5 low. Now, the 5 high and the 5 low are not set to the closing price. One is set to the high and one is set to the low. And what that does is it creates this band-like effect. It's a little bit like a Bollinger Band, but tighter. All right. So it's a little bit like a Bollinger Band, but tighter. So the purpose of the MAs, I'm using them as a trigger point for the strategy. So the 21 MA on the daily chart is the trigger point, and you then wait for the directional candle close, which we didn't get here, but we go further back. Okay. So if price comes down, I'm using that as my trigger point for the directional candle close. But The reason I'm using the 50 is I want to make sure that when I'm in a with the trend scenario, that when I get my new high has to be in a position where the 21 is above the 50 moving average. The reason I'm using a 5 high and a 5 low is these are there not only as a way of optimizing the entry on this strategy, and if you actually look, you can, because price isn't always going to make it back in a trending move, it's not always going to make it back to the 21 moving average. You can actually trade this strategy if price comes down to the 5 low, because you're given the option for a close above. Sometimes that will mean you have more losers, but it increases the trade frequency. You can see it there. So these I tend to use, these bands, I will use these for trailing stops. Now, I'm not going to go into trailing stops and how I do that today. You'll have to get more involved with this if that's something you want to use. But I use these bands for trailing stops and entries for other strategies as well. MAC below price. Again, don't worry about that, okay? That is specific to something. What I would say, Matthew, is focus on what I'm showing you. Okay, so don't worry. People get consumed by the MACD in relation to what I'm teaching you here. It's not relative. Yeah, so don't worry about it. Good question, Peter. Since you use a daily time frame and then optimize the entry on the 60-minute time frame, can you apply the same using H1 as the higher time frame? Great question, Peter. Love that. The answer is yes, you can. However, what I would say is that you would want to test that before you specifically did it, if that makes sense. Yeah. So test it first, because I don't want to sit here and say, yes, absolutely, because I haven't actually tested that. The chances are it will work, but it may need some optimization. So yeah, the principle of using the 60-minute pullback to the 20 and then going down to a lower time frame. Kerry, with her, one of my trainers who works with a load of guys in the DAX room, they have something similar where they look for a moving average cross on the 5-minute and then they wait for a pullback on the, there's a little setup that they use. Yeah, definitely try that out though. Yeah. The reason I'm showing you it on the daily and the 60 is I absolutely know both of these work because I have the data to support it. So I wouldn't want to say yes unless I absolutely had that data. How about using MA smooth? Don't know. There's no reason you could use an MA smooth at it, but you would need to test it. This is what people expect me to know. They expect me to know the difference between each of the different setups. I don't. All I know is it works on what I'm using. Is this strategy working overall? It's working on major indices. It's working on major commodities, gold, silver, oil, copper. The example that I showed you earlier was from copper, and it works on major currencies and major minor pairs. No, then the 200 for me is not there to identify a bullish or bearish market trend, Russell. It's simply there that I use it as targets. So I will use the weekly 50 moving average and I will use the weekly 200 moving average as potential targets, especially if they line up with support or resistance levels. The MA parameters for the 60-minute time frame are identical to the MA parameters on the hourly. So the criteria is different, but I'm using exactly the same moving averages. So I keep it really, really simple, guys. I use the same moving averages. It's just the entry that I'm using that is different. And I don't use all the moving averages in the same way. But yeah, some people say, why do you use a 21 instead of a 20? Well, that's what I was taught. So I thought I would trade that. Yes, yeah, simple moving averages, but the 5 high and the 5 low are both exponential. All of this will be shown when you get the strategy through on email, but the 5 high and the 5 low are exponential. The 21 is simple and the 50 is simple. You never actually know whether a trend is over until it's over. So I know that sounds like a silly thing to say, but for me, I don't play the game of thinking, well, I know when this trend is over. If we currently look at where oil is at the moment, you'll notice that we are approaching 2017, or actually, what is it? 2018 highs right here. Now, I've got no way of knowing whether oil is going to go higher or lower. Give me a yes if you all understand that. So I look at oil right here, and I've got no idea whether it's going to go higher or lower. but we are approaching an area where the last time we were here, we went down. So I am not going to look for any further with the trend trades at this point. Tell me why I would stop looking for more with the trend trades. Yes, we've got the 60-minute entry on this one here that could do a 4-to-1 before it gets there. But why would I not look for any more? Exactly. Well done, Henry. Just because there's a simple resistance level there. But I will wait for price to tell me what it's going to do. So in this scenario, I will wait for price to tell me exactly what it's going to do. If it comes up and reacts to that resistance level, I may have an against the trend trade, but it will then have to do certain things before I would consider it. For me, the trend will be over. And again, price can still go back the other way, but I will classify the trend being over when and if price not only breaks the trend line, but breaks the trend line with a new low that is lower than the last higher low, which is probably there or there, because we're on a weekly chart. Might go down to a daily just to have a look at this. Yeah. So in a scenario like this, I would want price to come down. Price would need to get down, break the trend line, new low, create a lower high that then break that low. And that's the point for me where a trend is, we're now in a downward trend. Doesn't automatically mean I will jump in on a short, but I would consider aggressive against the trends here because it is a strong resistance. I wouldn't take any more with the trend trades here. And I would only consider with the trend shorts once price was somewhere in this region here. Yes, if on the daily time frame, if price tests the 5 EMA, which is the most recent example, yeah, you can look for a setup there. That is going to massively increase your trade frequency, and it's going to give you opportunities for 4-to-1 risk to rewards, but it reduces the win-loss. And this is what most people don't tell you. They just tell you, oh, this strategy makes 200% a year or 50% a year. They don't tell you where it impacts because most people don't have the data. How do I identify our support and resistance levels? Sign up for our free training, Nonzo, and we will show you exactly how you do that. I haven't got time to do that now. All right. Good. So, guys, I'm going to have to take a break here because Anna's got her session that she wants to do with you and you've got the prize draw. So I'm going to take a break right now. And then when I come back, I'm going to go through data analysis, mindset, and I'm going to show you exactly how you can sign up for the free material. Over to you, Anna.
Okay, thank you, Alistair. Guys, I will just take 5 minutes of your time. I hope it will be a pleasant 5 minutes for some of you because some of you guys are going to win some bonuses right now, some trading bonuses from Instaforex, okay? So I will do the demonstration of the screen right now. So here we have all your...
You should be able to see it. Should be able to see it. Awesome. So yeah, what we're going to do is get you to a position where even if you've got a strategy that you know somebody else like me and our students are trading, if you're going to optimize it, how you effectively can look at trade frequency, win-loss ratio, and risk to reward. Okay. So these are the 3 factors that whenever you're optimizing a strategy, you look to work on. And as I said earlier, you don't want to, or you can, sometimes you might get lucky, but most traders try and either optimize win-loss ratio or optimize all 3. You should be focused on one and then building on the others after that. And the way you do that is very simply, what you do is you learn to record the right data in the right way. And this is where I would say 80% of the traders that I work with have got an issue with either the amount of data that they record. So most traders are not tracking their trades. And I was one of those guys at some point. If we go back, gosh, about best part of 18 years, I was somebody that wasn't tracking his trades effectively. I was too busy trading and too busy getting on with it rather than actually tracking my trades. And those that do, very often they're focusing on the wrong thing. So too many traders are obsessed with their win-loss ratio. And as a result, even if they're tracking their trades, breaking their rules, changing their strategy because they're too affected by the number of winners and losers. Now, yes, you can't have all losers, but it's a lot more, there's a lot more to it than simply just winning all of the time. And then when they do, the traders that do track the data, and even if they're tracking the right data, most traders don't actually know what to do with it. I'm actually doing a session with my trading room members tonight. And what we'll be doing, we'll be going through 3 or 4 of the 20 people that are there. We'll be going through their data for Q2 because we've just literally finished Q2. So before I go on holiday next week, I'm going to spend time with those guys tonight, evaluating their performance. But unless they've got the right data, I can't do that. So they get the benefit of my expertise and my feedback because they've taken the time to record the data. So I'm going to go through the absolute bare minimum that you should be recording when you're looking at any strategy and any setup, the absolute bare minimum. So a really useful one to do is record the trade number. Now, it sounds obvious, but what you should be doing is any trade that you choose to take, make sure you take a screenshot of that trade at the time you enter it, and simply put it in a folder on your desktop. So just simply have a folder on your desktop and place that screenshot of the entry in that folder and label it with the same trade number as you're putting on your spreadsheet. So what that allows you then to do is when you're reviewing your results on the spreadsheet, you can actually go back and visually look at the trade when you took it. You'll be amazed how many traders will evaluate a trade and say a trade is simply wrong because the trade lost. When what I want to do as your coach is I want to be able to see what you were looking at the time you placed the trade. So give the trade a trade number and then save your screenshot with the exact same number. And what that'll mean is then you can reference the trade result and reference what the trade looked like at the time you took it. Whatever time frame you're trading on, Terence. So if you're trading on a daily time frame, then you take the screenshot on that time frame. So you must know, and your strategy criteria must have a clear time frame of when you take the trade. So using the example I've just showed you, if you were trading off a 60-minute chart, you would be taking the entry off the 60. But if you were trading it off the daily chart, you would be taking the entry and the screenshot off the daily. So relevant to the time frame that you place the trade on. All strategies have what we call a trigger time frame. If you're trading off the daily on one day and the 60 on another day, and you're making up as you go along, then you haven't got a comprehensive strategy. You need to step back and review it. Number 2, what the strategy is. That's really important if you're trading multiple strategies. So most of my swing traders are trading at least 3 strategies out of the 6. Some are trading 6. Some of our swing traders are trading 5 or 6 strategies, or maybe 1 or 2. So you always label on the spreadsheet what strategy it's trading, so then you can compare the performance. You can filter down the performance. You'll see this on our spreadsheet here. So we're able to look from a data point of view at the different results for all of the different swing strategies individually. So we can filter out different strategies. We can look at the overall performance, or we can look at the individual performance for each of the strategies. Very, very important concept to be able to do. Next one is what market you want to be able to analyze if you're trading multiple markets. I've got about 35 on my watch list as a swing trader. Some day traders are only trading one market, so they don't need to do the same thing. But if you're trading multiple markets, you must log which market it is, because it might simply be that over a certain period of time, your strategy is performing well on some markets, but not performing well on others. So knowing that is hugely important. Another simple one is log the entry date. This will allow you to filter by week. It will allow you to filter by month, and it will allow you to filter by week. So always log the entry date. Obviously, if you're trading as a day trader, you want to log the entry time. Now, our day traders will log the entry time, and what that will allow them to do is see which hours during the day work better than others. So a lot of traders, I've coached a guy, he now lives in Australia, a guy called Chris. In his first 3 months of trading, what he was doing was he was essentially trading from 8 in the morning all the way through to about 4 in the afternoon. But 60% of his losers all came between 11 and 1. Ironically, when the market got quiet. But because he was tracking that, when we did a review of his data, we were able to see that. Now, that's not something that complicated that I was telling him to do. I just simply said, don't trade between 11 and 1. And that reduced his losers by 60% going forward. So something as simple as that can have a massive impact on your trading and on your results. Whether the trade was long or short, this is important. You're not necessarily needing one trade to be long, one trade to be short, but certainly if you're new, a lot of traders will bias long trades because their eyes are not tuned to looking for short trades. So definitely log whether it is long or short. You'll see this on the spreadsheet in a second. Exit date. So log when you got out of the trade, which will allow you to track the number of days you're in a trade. So a lot of traders start to get itchy. They start to break their rules. They start to get fearful or doubtful if they've been in a trade for a long period of time. Well, just showing you the results of that daily strategy here, if I just pull that across, you'll look, some trades you're in for 5 days, 3 days, 4 days, 16 days, 1 day, 23 days, 1 day. Look, 127 days we were in one trade, 11 days, 3 days, 7 days. So what you're able to do is look at the average and look at the outliers. And that helps you understand that you don't know, there isn't necessarily an optimum amount of time. All right. So number of days in a trade, hugely powerful, because I see a lot of traders make that mistake of once they've been in a trade for a week, they start to get nervous and get out of that trade. Then obvious one, whether the trade was a winner or a loser, because even though win-loss ratio shouldn't be your number one priority, you still need to know whether the trade was a winner or whether the trade is a loser. That's AM UK time. I'm not saying don't trade for that. I'm saying in that example for Chris, during that period of time, 60% of his losers came between 11 and 1. So the specific advice I gave him, Mano, was to not trade at that time. It might be completely different for you because your data might not say that. So don't assume that I'm saying that as a comment for everyone. All right, that was very specific for him, but I'm telling you that that is a useful tool because you may see a pattern as to when your losing trades come. When I first started out, I was able to see that when my trade frequency was higher during the morning, I would very often, if my morning wasn't profitable, I would end up placing more trades in the afternoon because I was trying to recoup my losses. But I was able to see that statistically and then make the appropriate decisions to change that rather than just guess. So the example I was giving was specific to Chris. Your data, if you track that, may show something completely different. Then here, you need to make sure that you track your risk to reward. Now, the way we do it on our spreadsheet is the win-loss. You'll see this in a second. The win-loss here is in red is the loss. Green is obviously the win. But then you can see the risk to reward is based on numbers. You can see it there. Look, 5.25%, 1.36, 2.28. So you can see the different risk to rewards in there. Very, very important. Not enough traders are putting enough emphasis on what their risk to reward is. Maximum drawdown. Maximum drawdown, very simply, is the maximum a trade goes against you in two conditions. If the trade is a winner, then it's useful to know, if we look at that same example that I showed you, it's useful to know if that trade went into a losing position before it went up and hit target. If it did, you can see that, let's say, for example, the stop size on that trade was 100. Your drawdown was approximately 60. So over time, what you can do is you can look at your winning trades and you can see what percentage of your winning trades go into a losing position before they go on to hit their target. This is a hugely powerful thing to know about your own trades because most traders don't know it. And what do most traders do, guys, when a trade goes into a losing position? What do most traders do? Yeah, win-loss in percentages. Yeah. So what do most traders do when a trade goes into a losing position, especially if that trade went into a winning position first? Extend the stop. Brilliant. And if you're saying that, you've probably done it. I've done it in the past. They'll close it, Henry. They'll doubt the trade. They'll get out early. They'll move their stop. And if the trade spends a long time in drawdown, they can often doubt whether they should be in it. The copper example on the PDF you're going to get tomorrow goes in and out of a losing position 4 times before it hits target. So knowing that 78% of your winning trades or 60% of your winning trades go into a losing position before they hit target, psychologically, that puts you ahead of nearly every trader out there, because most traders just panic when a trade goes into a losing position. On a losing trade, however, knowing whether or not the trade, oh, let me ask you guys, how many of you have had this happen on a trade where you've got your trade, you've got your setup, it nicks you out and then goes up and hits your target? Yeah, always. I hope it's not always, but this happens. This will happen to all of us. It's just part of trading. But on a losing trade, this is all I want to know. I want to know, was it a good loss? Because that's a good loser. Does everybody understand? So if a trade rolls over, stops me out and keeps going, that's a good loser. I'm happy about that. But if the trade does this, nicks me out and then goes and hits target, I was right on direction, but my stop wasn't automatically too tight. But what I want to know over a numerous number of trades is, do I need to widen my stop? So it's only a good loser if you stick to your rules and price doesn't keep nicking you out. But this will happen now and again. If it's happening 1 in 30 trades, 1 in 20 trades, that's just the way it is. But if it's happening regularly, it might be that you need to widen your stop because the broker has decided to increase the spreads. So knowing max drawdown, both in a winning trade scenario and a losing trade scenario, very, very important. Next one, maximum exit. Again, most traders, I'm sure some of you have done this, where you've taken the trade, your target's up here, price comes along, it gets within an inch of your target, 2 points away, comes back down, you start stressing, you start thinking, and then price comes back up, it hits your target, and immediately at this point, you feel a sense of relief. Who's experienced that? So it gets really, really close to your target, it comes away, you panic, and then you feel a sense of relief. Yeah. And then 3 days later, it's here, and you're saying, I should have stayed in. Has anyone done that? You wonder why mindset-wise you're not right for trading. Yeah. So why you're saying you should have stayed in with the benefit of hindsight, but nobody has the benefit of hindsight. This is why I spend so much time coaching people on their mindset, because their mindset is set up completely the wrong way. They forget that 3 days ago, they were practically begging the trade to hit target. Literally 3 days before, they were begging the trade to get to here. And then 3 days later, they're like, I should have stayed in. So here's what's important. You should, however, assess how much your trades run on past your target, because over a decent enough data sample, you can then evaluate whether you can bring in a stop management or a trailing stop strategy. So what we will do is we will mark on the max exit for all of our trades, whether we're using a trailing stop strategy, a fixed target, so a fixed risk to reward, or whether we're using a variable risk, variable target, so a moving average. So then what we're able to do is get to the point where we can start saying, actually, this strategy has more capacity. And I'm constantly seeing what capacity the trades have. So these should be the things that you should be marking, not on a weekly basis, on a trade by trade basis. And if it's a lot of work, well, what did you think trading was? Easy. Remember, trading is the easiest. It's the easiest way. It's the hardest way to make easy money. There's still hard work involved. There's still diligence. There's still data analysis. There's still these things to do. Good. Now, I am running out of time, so I am going to go through these next 2 sections, but I'm going to make sure I cover some key elements before we come to questions. So risk. Risk, very simply, is something that most traders are either doing well, but at times breaking their rules, or traders have no idea about risk at all. So risk management in its basic form is very simple. Never trade without a stop loss. If you are, then it's going to end in tears at some point. Never over leverage. So what I mean by that is we have a rule, no more than 2% of capital risk on any one trade, but that relates to trade frequency. So some of our strategies will have a 2% risk, some will have a 1% risk, some will even have a 0.5% risk. Martin, on one of his day trading strategies, has a 0.01% risk because his system places 50 to 100 trades at any one time. It's an AI system. But for me, I'm working at 1% or 0.5%, but on one of our strategies that I trade, because we only trade that strategy once a month, I trade at 2%. So the amount will never be more than 2%, but whether I trade at 2%, 1%, or 0.5% is relevant to trade frequency and the results and the drawdown figures that I've had on my trades. Then I only move my stops. So a lot of people will tell you, move your stop to break even as soon as you can, and then it can't be a losing trade. Has anyone had that? Move your stop to break even, then it's a guaranteed no lose trade. And some of you may have moved your stop to break even because you feel a sense of relief in that moment. Well, let me show you something really simple. What if you move your stop to break even and that trade would have been a 3-to-1 winner at 1%? You've just missed out on 3%. What if you move your stop to break even too soon and that would have been a 3% winner? And then the next trade comes along and doesn't get anywhere near, it doesn't move into target, it goes straight to a loss, -1, -1. In that scenario, you're down -2, whereas this trader is already up +4. You've now got a 6% differential over 4 trades because you decided to move your stop to break even to do that. And that's fine. And having that differential is fine if you've tested the data and you know you should be doing that. But if you haven't got data that says move your stop effectively once price reaches a certain level, don't do it. We had a strategy where the strategy ended up being a losing strategy if we moved our stop to break even once price had done a 1-for-1, because too many of the trades came back and stopped you out of break even. The target was a 3-to-1, but we found the optimum for it was when you got to 2-to-1. So if you waited 2-to-1 before you moved to stop to break even, the results actually improved. All right. So to me, you should, unless you've got the data that says move your stop up, you shouldn't be doing it. But you shouldn't be trading a strategy unless the data says it's effective to not move your stop. Aim for bigger risk to rewards than 1-for-1. 1-for-1 is okay, but understand that you've got to then, if you trade at 1-for-1 the whole time, and most traders are trading inverse, but if you're trading at 1-for-1, then your only thing that's going to make you successful is your win-loss. When you lose, excuse my language, don't lose your shit. And what I mean by that is when you lose, that is when the temptation is to go from a 1% risk to a 2% risk, or a 2% risk to a 4% risk. And it's in those vulnerable moments that most traders, even if they're following effective risk management, will break the rules. And as you've said there, Faisal, they'll revenge trade. So what I'm doing whenever we have a losing run, which we have on our strategies, is I'm watching to make sure the guys in the trading room aren't suddenly thinking about over leveraging, because a lot of traders will want to win back their losses. And then it happens to be just at that moment that that strategy has its first 5-trade losing run. And instead of losing 5% and clawing it back nice and quickly, once the winners come, you end up losing 1%, 2%, 5, 2, 4, 6, and you're down even more. So a couple of examples of where risk to reward comes in. The whole goal, regardless of whether you're trading with a big account or a small account. Here, look, if you look, my profitable months, 7 there, 15 there. There's not necessarily purely losing, winning trades there. But if you look, even if you go down to the months where I end up losing, look, I had losers there. I'm only down 71. Why? Because the size of most of my winners is bigger than my losers. You can see it through there. So even when the months aren't as profitable, I'm not losing anywhere near as much as what I'm winning. And that's the key. And they're just some recent months on just one strategy. It doesn't matter whether it's with the trend strategy, against the trend strategy. I'm looking at when I don't have a good month, I'm not giving back all of my profits. All right. And part of the way you do that is the last pillar that I want to talk about, which is creating a bulletproof trading mindset. Now, one of the subjects that's not talked about enough in trading is this. Who here has heard of the concept of recency bias? Give me a yes if you have, give me a no if you haven't. Oh, lots of you haven't. Some of you have. So recency bias simply means this, that as human beings, we tend to put a greater emphasis on what has happened more recently. Those of you that didn't understand it, give me a yes if that concept makes sense. So we tend to put more emotional emphasis, more brain space, more brain capacity, more thought on what has happened more recently than what had happened in the past. We tend, for things that happened previously, need some sort of trigger, be it an emotional trigger, like a song, a thing, a result in your trades. Often, how many of you have ever, I don't know, you've ever smelt a fragrance or a perfume and it takes you back to the place where you smelt it before? You weren't thinking about that place 2 seconds earlier, but the smell has put you back there. Yeah. So it's a lot of what happens for us to be triggered about our previous thoughts needs to be a situation, a circumstance that comes up in that moment. Otherwise, we tend to be thinking about what is happening more recently. So if we're thinking about more recently, the fact that our trades have actually been winning more recently, what are we likely to feel? More underconfident or overconfident? If our trades have been winning recently, most are likely to feel more overconfident. Some will actually get a little bit nervous because they've started winning. I'll talk about that in a minute. And that can affect what we do. But we tend to be affected more by what happens more recently, as I've said, but also here, if what has happened has been more negative, because we as human beings are designed to deal with threat and prioritize, threat over everything else. So losing trades can be seen as a potential threat. Most people logically know they're part of what has to happen for you to be successful, but most traders see them as a threat. So they tend to spend too much time thinking and as a result, reacting to what has happened more recently. So winning trades can create overconfidence, but losing trades more recently are more likely to create underconfidence in what happens. So we tend to feel uncomfortable. It can drive further risk taking. And this is why when I speak to most traders, if I say, tell me the performance of your strategy, most people will tell me what happened that day, that week, maybe that month, possibly that quarter. But very few can tell me the results over a year, 2 years, 3 years, 5 years. And coupled with that, what we've just covered, most people don't have the data for it. So if you're in a rut of fear, you've timed your question perfectly. There's certain things you can do. Is you need to understand, bad rule, that fear, first of all, is just part of trading. So there's a certain amount of it that you just have to deal with. Now, one of the ways to do that is to accept you're in that and actually get the facts down on paper. And that's where data, what we've just covered, is so important, because very often, because we are more threatened by loss and we're thinking about it now, we may have forgotten the fact that we were winning 2 weeks ago. Give me a yes, Badger, if that makes sense, and everybody else as well. So if you haven't got the data, it's very hard to be rational, because all human beings, I can tell all of you, be rational, and then you go away and 2 days later you're fearful because you've had 3 losing trades. But if that 3 losing trades is just standard relative to the data over 2 or 3 years, and if you can go back and say, well, I actually had a really nice winning run before that, it's easier to accept the losses. So one of them is accept they're part of it and get the facts on what it actually means and get that relative to past trading history. So the performance of the strategy. What you can also do is test the strategy you've been trading over the losing period. It might just be that the strategy is losing. But if the strategy's been winning for the last 2 weeks and you've been losing, then you know that there's something specific to work on. But if the strategy's been losing and you've been losing, well, then you go, well, okay, it's just what it is. I've just got to trade through it, instead of changing to another strategy and changing to another strategy, which is what happens all the time. And then be aware of whether your response to fear is either over trading or under trading. So be aware of what your response is. If your response is more likely to be over trading, be aware of that. Journal that. If your response is more likely to be under trading, again, be aware of it. Journal it. And that awareness will help you. Get feedback. Get some accountability. Somebody like me, if I'm your coach and you're in my trading room, you can get accountability from me. And simply saying, I'm simply letting somebody know real time that you're feeling fearful at the moment. I think I'm actually going to start over trading. Sometimes just the mere fact that you've acknowledged that puts you in a position where you're less likely to do it. But most importantly, understand how your personality style is driving you. So I'm very short on time, guys, but I really want to do this because I think this will help you. And this is something that I use with all my students. I use this tool, even if I don't say it to them, I use this in part of my coaching process. And I learned this years ago. There are essentially 4 key personality styles. Now, nobody is one personality style. You're not either one of these, but you tend to be either more right side or more left side in how you operate. Now, right side tend to be more internally driven. These guys tend to be, the right side I've got that wrong. Right side tend to be more fast paced, more impatient. The guys on the left tend to be more slow paced and are more patient. So a driver is somebody that values winning heavily. So if they value winning heavily, we all like to win, but they really value it high up on their list of values. What do you think they hate? They hate losing. Vandral, yes, some over trading and under trading is subjective. That's why you need to know what the results of the strategy are. And that helps if you're working in a group of people who are trading a similar strategy to you, because then you can see where you are at. If I'm tracking all of the trades that we trade as a group in our swing trading room, then I know whether or not that person is over trading or under trading. So data drives that. So yeah, you're right, guys. Coming back to this, they hate losing. So they hate losing trades. Now, because they're fast paced and they're very driven, do you think they are more likely, if they're losing, to under trade or over trade? Which one do you think? Exactly. They are far more likely to over trade because they want to get back to a winning place. Whereas analytical people love to be right. They love the data. They love the strategy. They love the detail. So analytical people are more slower paced. They love to be right. What do you think they hate? What do you think analytical people hate, guys? Hate to be wrong. So when trades lose, they see it as wrong. They're more likely in that moment to be very careful. They're more likely to go back and fiddle with the data. So when things are when things aren't going well for them, are they more likely to under trade or over trade? Which one? Under trade. Brilliant. So yeah, far more likely to under trade. So then what happens is when the trade strategy starts turning around, they miss out on the profit. Now, expressives, these guys like to have fun. They like things to be interesting, dynamic. So what do you think they hate? Expressive, life and soul of the party, not losing. They hate being bored. Yeah, they hate when things are boring. So if they've got no trades, actually, an expressive doesn't really mind if they're losing or winning a lot of the time because they're just, something's happening. Yeah, they hate missing out. But one of the things they really don't like is if they're just ticking along sideways. They tend to have too many strategies running at once, or they're doing trading and property investment and online business and 1,000,001 different things. If they get bored, they'll often get distracted and then they'll miss the opportunities when the strategies start running, and actually ironically miss the most exciting bit of it. Amiables like the status quo. They like things to be just so. They like things to be steady, and they don't like, and so they hate things. They hate too much. What do you think? They like things to be steady. They like the status quo. They don't like lots of what? Conflict or change. Yeah. So they don't like a lot of conflict or change. So these guys, very susceptible to under trading. They lack, they don't like stress. Brilliant. And they lack confidence. These guys over here actually susceptible to over trading. Too many strategies, getting bored, placing trades they shouldn't, breaking their rules because it's exciting. So can you see that the guys on the fast-paced side are more likely to be over traders, and the guys and girls on the left-hand side who are more slower paced are more likely to be under traders? So it's not about saying you are one of these. First, think about which side do you tend to be on. When you hit a losing run, do you evaluate by going back to and spending too much time out the market? If you hit a losing run, do you suddenly see your trade frequency go through the roof? I was this, and I was able to track it on my data. So having this, amiables actually make very, very good traders because they are very, very good at following the rules. The problem is they often lack the confidence to start. So straight away, guys, can you see that there are strengths and weaknesses to these? No, it's not that fast-paced tend to lose more. Fast-paced tend to overtrade. Fast-paced tend to lose. Maybe they will have more losing trades, but they'll have less missed trades. Make sense? Whereas these guys will tend to back away. So they'll have, so what you're looking at here, guys, effectively, we call this in the trading room a trader's loss response. So what do they tend to do? So we get them to do a personality evaluation to see either which side of the quadrant or which is their dominant personality style. And then we wait until they have a losing run and look at their loss response and see if they marry up. And nearly every time they do. So I'm this. I'm a driver expressive. So why do you think I started with day trading? Because it was exciting and I could make more money. But what I ended up doing, over trading. Every time I had a losing run, I would revenge trade. I would justify it by saying, I just need to get back to break even for the day. But the problem was when I started out, I didn't have the coaching, the mentoring, and I didn't have the data on my strategy. So I didn't know I was doing this. It wasn't until I actually got someone to coach me that I realized where I was going wrong. And then I could be aware of where I was going wrong. And then I could do something about it. So as it says here, where you tend to go wrong in these scenarios is when you're at extreme-based scenarios. Now, that can be whether you're winning or losing, but you portray the negative traits of your primary personality style when your trading results are at usually at the extremes. So losing runs or winning runs. When everything's ticking along, apart from expressives, if it's ticking along and you're doing okay, that's fine. So be aware of these extreme-based states, winners or losers, and look at what your loss response is. It's very, very important. And as I've said there, very often you won't realize you're doing it. So start becoming aware of it and start doing it. So what can you do right now? Well, obviously there's a lot of information here. So as Anna has already mentioned, you will get the PDF of the strategy. You can watch the recording. But what I think it's important for all traders to do in all 4 areas is start getting a clear understanding of the basics, even if you have been trading for a fairly significant amount of time. Most traders I meet that have been trading for either a year or even up to 2-3 years don't understand the basics and aren't able to make the basics fit together in a way that I've just shown you. So come and get involved, learn and apply our 4 pillars. And if you want to get involved at a higher level, be it trading once a month, looking at 5 to 15% return per year, or getting into the 50 to 100% bracket, but come and learn the basics, both free and on our next Kickstart training. Come and do that with us. All right. So next step, I'm going to pop the link in the box in a second, or Anna's going to send the link out because I don't think mine are coming through. But you can come and join us on our free membership. So you can have access to us as a free member for life. you need to think about is 3 words: traders, support, and club. Just go to traderssupportclub.com. And once you're there, you'll come to a website and you'll see me on there. All you need to do is click on any of these start right now buttons. If you do that, a little box will come up. You just need to fill in your details, and that will get you instant access to our free membership, where you'll have your own dashboard. There will be trainings there. And I'm doing a very, very new and specific webinar on the 21st of July. It's called the Beat the Banks Discovery Call. We have got free trainings coming up this quarter in August and September, but this is the next training I'm doing. This is something completely new that I've never done, and I'm only doing for TSC members. I'm going to give you the opportunity to get involved with a hands-on or complete hands-off strategy. And I'm going to tell you more about that on the 21st of July. So once you're a member, you will see that event, that specific event in the box up here. You can register for the event. Please make sure you meet the criteria for that. But we've got other free events happening as well. All right. So that's for everybody here. That will also, as somebody who's come through ShowFx, when we do live events or when we do anything in the future, there will be the opportunity for discounts there as well. So it's traderssupportclub.com. Okay, it's 3:20. Anna, have I got time for a few questions? Because I'm sure there's people who've got questions here. So do I have time?
Sure.
Yes, okay.
Yeah, you do.
Brilliant. So guys, over to you. Has anybody got any questions they would like to ask me? We do a few minutes of questions before we finish up. Has anyone got anything they want to ask me about anything that I've covered today? I saw a few random questions coming in. I think there was one about strategies. Should you trade one strategy or multiple strategies? Eric, do we need to stick to one strategy or apply multiple and compare them? What's your opinion? It all depends on what it is you want. Eric. So the easiest way to think about it is, if, let's say, for example, you wanted to achieve a consistent return of 50% a year, then if you have a strategy that on paper makes, let's say, 90% a year as an average, and you're able to deliver around the 50% mark, I might say to you that you don't need to take another strategy on, but you might want to take another strategy on, because most people want to trade more than they are. But you have to look at it and say, if I was to take another strategy on that could make me an additional 50%, what would the drawdown of that strategy be? Because the first strategy might have periods of drawdown where you have a 5 or an 8% drawdown. But if you add another strategy in, and both of those strategies have a drawdown at the same time, then you may end up with a 10 or 15% drawdown. And that might not be what you want. So it's very difficult to say stick to one strategy or have multiple strategies. From a learning point of view, start with one. So what I tend to say to our guys is I get them to assess whether they prefer with the trend strategies by what they can see, basically what they see easiest, against the trend setups or trend line breaks. And I get them to only trade one strategy first. Does that make sense? So I get them to trade one strategy first. And if they get that strategy down, then they can either trade another strategy in the same condition, or then they move to one of these two conditions, but not all of them at once. Yeah. So if you're trading multiple strategies, first of all, you want to evaluate which condition they're in. They're either in the same condition or multiple conditions. And then I would master one. So if you're not having the results you want trading multiple strategies, pull it back and focus on getting good at one. And that's not just about the results, that's also about the process. Good. Is my daily chart based on New York or London? It's based on London, Phil. Yeah, all my timings are based on London, because then that's in line with my broker. Yeah. Azil, is there a, right, I get asked this question all the time. Is there a way to identify a fake out? What most traders are not doing is, most traders, again, if you think about what I was talking to you about recency bias, is most traders are thinking about the last two trades that have faked them out, and they want an answer to it. If you think about whether or not it's a continuation pattern or whether it is a reversal pattern, if a trade goes the way you don't want, they're all fake outs. So they're all fake outs. So in a scenario like that, what I would say is quantify how often it's happening. So let's say it's happening 50% of the time, and you're trading at a 1-for-1 risk to reward ratio, then it's going to hurt you. But if it's happening 50% of the time and you're trading an average of a 2.5 to 1 risk to reward ratio, then it's not a problem. So I get asked this all the time. What can I do to avoid fake outs? But quantify them first. Good. Is it possible to get the spreadsheet? No, the spreadsheet you can only get as part of our total trader community. At some point, we may sell the spreadsheet individually. If you're a free member of Trader Support Club, you'll be the first to know that. But no, you can't have the spreadsheet because you need to understand how we use it. And you've got to be, and the benefit is if you can get the feedback. So no, you don't get the spreadsheet. No, we've invested, that's our 8th spreadsheet. We've probably invested the best part of about £5,000 in coders to get that to work specifically. So no, only our total trader members get it at the moment, but eventually we may well sell it. What's the minimum amount to start trading? Depends. It depends on your strategy. It depends on what your broker's minimum stakes are. But I would say if you're equating it to pounds, because that's the currency I'm in, I think we say to people, you don't need to start with any more than 1,000. If you've got plenty more, if you've got 50,000, start with 5. If you've got 100,000, start with 5. So don't necessarily start with the maximum amount of money that you've got. You can start with 1,000. That'll get you going, because you can trade. You can still manage risk effectively as long as your broker's minimum stakes are low enough. I find that sometimes my stop loss gets me out of trade too early. How do I avoid that? Again, Gillian, you've got to equate what that actually means. So it's a little bit like getting faked out. It may happen if it happens on out of 100 trades. If it happens on, so what you're basically saying, I imagine, is your stop's too tight and the trade ends up going the way you want. But you need to quantify how often that's happening. If it's happening 1 in 2 trades, then you probably need to widen your stop. But if it's happening 1 in every 10 trades, and on the other trades you're having genuine losers, let's say you got 10 trades, it happens 1, another 4 trades are losers, and the other 5 trades are winners at 2 to 1, there's nothing to worry about. It's just par for the course. So you need to quantify it. This is why data is such an important pillar. How much of candlesticks confluence in this strategy? I couldn't give you the specific numbers to say that the candlestick adds this much to it, because that particular strategy, we've always traded it, well, over the last 3 years, we've always traded it with a directional candle close. The reason we like using a directional candle close on swing trades is it means that the person can simply place a buy stop or sell stop limit order at the end of the day, UK time. You could test it on just coming into the 21 moving average, but we know that the optimum way of doing it is with the directional candle close. What do we see in your strategy to stay out of the market? Well, David, it's a with the trend strategy. So as I've said with oil, and I used that example earlier, if price is getting close to a resistance level, then and it starts to set up, then I may use my discretion ahead of that setup and say I'm not going to trade it, or if it's at the resistance level. So I'm only going to trade that. Now, I could be proved wrong in that scenario, but I don't care, because if price is going to do this and then break that, that's when I then want to get into the strategy. And if I lose out on one trade because I don't want to trade at resistance because the last time we were there, that would be what I would looking out for. The only other thing I would look out for specifically is sometimes markets can be range bound. So what you end up with is you end up with a range bound period, especially in the middle of a trend. Just be careful that you're not taking trade after trade after trade, because you've got tiny little new highs. Make sure the new high you get, if it's mid-trend or it's consolidating at a resistance, is a clear new high. So they would be the two things. Watch out for the resistance and support levels, clear new highs and clear new lows. Be careful of when the market is choppy and you think you're getting into a good quality trade, and actually what you're doing is doing that. What are the softwares you use? Are auto trading tools good? I like auto entry tools. I don't like automated robots unless you physically cannot trade the strategy. If you've traded the strategy, you understand the strategy, you own the strategy, and you're fully immersed in that strategy, then using a robot to trade it is okay. The challenge with robots is most robots that you buy, they're using dodgy systems, they're using things like martingale, they're using systems that most traders can't stick at. And a lot of traders go to a robot because they want to get rid of the responsibility of discipline. So I use what's called auto entry systems. So I will still decide which market. I will still decide if I'm happy with the trade in question. And if I am, then what I use is I use an EA on MT4, and all that EA will simply do is just do the last bit of the trade for me. That means if I'm not around, especially with those 60-minute entries, the EA will do that. So again, those sort of things can be programmed, and we've got a programmer that does all our EAs. Other softwares, I choose Pro Real-Time Charts. A lot of our guys use that, or TradingView. And yeah, I use MT4 for my EAs and my trades. Do you scale your positions? If you know your position is in a way with a trend line, do I scale in? I did when I did more day trading, Matthew. I used to scale in a lot more. You could effectively, with what I've just shown you today, you could effectively scale in with that trade. So if you think about the 60-minute entry, that 60-minute entry, if you think about the daily, you're waiting for the daily directional candle close to close positive. The chances are, on a lot of the setups, the 60-minute close above the 50 is going to happen sooner. So you could choose to trade both of these, scale into the first trade. So go in at half stake, go in at this trade, the other half stake. And if the daily directional candle doesn't set up, then you've only got half stake in the trade. But yeah, I do it less so as a swing trader, but I did do it as a day trader. Yeah. Again, that's something that is more about personal preference. Some traders can perform better if they can find multiple reasons to leg into a position. Yeah. So whether I do it or not is not necessarily a reason why you should. Yeah. How to make consistent profit. That's a too broad a question for 5 minutes. Go through and do and make sure you master the 4 pillars that I've shown you, and then get some accountability and make sure you got a clear process and you track your trades, understand your personality. Basically everything I've shown you today. Cool. I'm just going to scroll down and see if there's anything more. How do you normally execute your entries? Pending order. Yeah, pending order, Pan, for me, because I'm not a day trader. So yeah, I'll do pending orders, or I'll use my auto entry EA to do that last little bit. Can this knowledge be applied to binary options? You'd have to test it. I don't like binary options. I actually physically, when I first started trading, I started trading as a options trader, trading covered calls, and I was buying puts and calls. So that's how I started out. But I don't like binary options. Binary options is basically set up so that you lose money. I'm not a fan, because the last thing I want, and if you saw with the spreadsheet, you can see on the spreadsheet that I don't know the time frame by which my trades are going to hit target. Look at that winning run there. 1 day, 5 days, 7 days, 15 days. I don't want to put a time constriction on my trades. So for me personally, I wouldn't want to trade binary options, and I don't know whether or not those strategies would work. I would highly doubt it. Will this strategy work on all timeframes? You'd have to test it, as I said earlier. I don't know that. I know that it works on the daily, and it works going from daily to 60. Then on that 60-minute chart, there's 3 of us within Traders Support Club that have tested that. So you're getting the benefit of 3 members who've paid the best part of £5,000 to work with me. You're getting the benefit of their testing. But on any other timeframes, you'd have to go away and test it. Summarize the 4 pillars. Number 1, discretion, reanalysis, and proven strategy criteria. Number 1. Number 2, data analysis. Number 3, risk management. Number 4, mindset. Think of them like a table. You need to be proficient in all 4, and being unproficient in one will have an impact on the others. It's like a multiple effect. So you've got to be proficient in all 4, but if you're unproficient in one, it'll have a multiple effect on all the others. This is why so many traders aren't successful. Do you consider chart patterns in your analysis? I don't really, other than double tops and double bottoms, Pan, and I will use divergence on those. I'm not a big chart pattern person. I like, some of our guys will trade ascending and descending triangles as part of their breakout setups, but I'm not a big chart pattern person. I'm not saying they don't work. It's just not something that I use. All right. So again, just because I don't use something doesn't mean it isn't necessarily effective. Where most traders go wrong is they try and use chart patterns, indicators, moving averages, Fibonacci. They're trying to use it in the wrong way. So again, test it to see if it works. If you like them, great. But liking them is not enough. You need to know that whatever in the way you're trading them has a statistical edge in your favor. How do you consider a good broker? A good broker needs to be regulated by your country of origin. So obviously I'm in the UK. So it has to be regulated by the FCA. The broker needs to have what is called a ring-fenced client account, which means your money is ring-fenced in a specific account. So if anything was to happen to the broker, you would eventually get your money back. So not only are you protected by the regulation in your jurisdiction, it's a ring-fenced client account. Okay. In the UK and the US, we have some of the highest regulation globally as well. The Far East is very good as well. So just be careful of brokers that are out in the middle of nowhere. Don't always automatically go for the broker that gives you the best leverage, because that doesn't necessarily mean they're going to be the best broker. Cool. Before entry, what SOP do you use? What do you mean by SOP, Ahmed? What's that referring to? What standard operating procedure? Is that what you mean by SOP? Yeah. So my discretion gives me the standard operating procedure. So for me, the number one element is defining where that market is. Because if that market is a with the trend market, it goes into the with the trend watch list. And then my operating procedure is to check in the morning and check in the evening to see if the relevant criteria have been met. And once the relevant criteria have been met, I calculate my risk, I place the trade. So my week is very much 20 or 30 minutes in the morning looking for trades, Monday through to Friday, 20 minutes in the evening, the same. And then at a weekend, I will update my spreadsheets, review my trades, check that I followed my procedures, and that's pretty much me done. Cool. Guys, any other questions? Good. I hope that was useful, guys. I know I packed a lot in there. All right. The most important thing is you apply all of those. So thank you very much. It's been great. It's great to see so many of you and see a few familiar faces. Anna, thank you very much. I'll hand back to you.
Thank you. Thank you so much, Alistair. Thank you for participation. Guys, please don't go away. We still have a lot of interesting stuff for you today. And each of you has a chance to win 1,000, 2,000 US dollar bonus, or even iPhone. So I'm now giving the floor to the representative of Instaforex, who is our sponsor. But before that, guys, we have another surprise for you. We have something that we want to give to any of you. Any of you can get some special prize from us. And to demonstrate to you that, I will go to the demonstration of the screen once again. So here you can see a special prize that any of you can get. This is called Forex training course from Instaforex. And it is a whole trading guide of 60 pages, covering all concepts, all basic principles of trading, starting from, Forex trading instruments, chart types, time frames, graphical tools. Then you go to the basic concepts of technical analysis. Then you go to graphical analysis. I'm just showing to you the content of the book, okay? So trading techniques. So here you can see the whole trading guide, which covers, I think, about 60 different subtopics about trading. So my question to you guys is, do you want to get this Forex trading guide for free? Whoever wants to get this for free, please write yes. Okay, great. I can see many yeses. So what you need to do to get this for free is very easy. You just go to our Facebook page, and my colleagues will write to you the page once again in the box, I believe, or maybe I can even write to you the name of the page. 1 second, right here. Okay, so you go to our Facebook, and there's a section there that's called reviews. You go into the reviews, and you write to us your feedback. We really appreciate your feedback about the webinar, because in this case, we will be able to improve our webinars. Maybe you could tell us about your expectations or recommendations for future webinars. Everything is very, very highly appreciated by us. So please leave us reviews, and the authors of 10 best reviews will get this book for free. Okay? Okay, thank you so much, guys. And now I will give the floor to Pavel, representative of Instaforex. Pavel, are you here?
Anna, it seems I'm here. Thank you very much for introducing me. Guys, let me share with you a bit of plans for the coming 20 minutes. So the first 10 minutes, I will share with you a presentation about our new product. And first of all, I would like to say, to apologize in front of our great Malaysian audience who have actually been at our previous webinar, because the presentation will be very much the same as I did, because this is another English webinar, yeah, which is mainly directed to international audience. So if it might get a bit too boring for you, because the information will be a lot the same as it used to be 2 weeks ago. So in case, just in case you've heard it, I'm not sure, enjoy the things you wanted to do and be prepared for the quiz. And guys, especially for our international audience, which is enjoying the first ever webinar of ShowFx World, after my presentation, we are going to hold a quiz with very interesting questions, I hope, and with very nice prizes. So that's probably it. And now let me move towards the presentation. Just let me share with you the screen of my computer. So here it is, guys. Okay, so the new product, which most of you don't know actually, it has just recently been published on our website, and it's called On Your Side. So OYS on your side. So, and the message is earning together with your broker. So let me tell you a bit more about this product. So this is the message: profitable, reliable, conservative, and the link to that page where you can know a bit more. But I don't suggest you to go to this just directly right now. First of all, let me tell you some words from myself. So first of all, the very basic idea of this product was the following: but fighting against the market is not easy at all. Probably some of you who like old American movies as much as I do remember the movie Over the Top with Sylvester Stallone, who was fighting against this huge guy. He managed actually to win. Yeah, so he won this arm wrestling tournament. So yes, everybody can win against the market, but it's not easy. And if you are not sure, let me give you a bit of statistics. If you go to the main page of the website of any European Forex broker, you will be able to see on the very bottom of the main page some information. And the reason they do this, because they are obliged to publish the real data about the performances of their clients. So when you read something like Forex and CFD are not easy and risky, and something like 75% or 85% are losing money, it's not some figures they took out of their heads. They provide this data to their regulatory bodies, and they have to publish it. So all this data is real, and according to this data, only between 10 to 35%, depends on the time, depends on the broker, actually earn. So the overwhelming majority loses. And we thought that the solution for this was needed. But before we present you this solution, let me briefly explain why this product can be not for you. The first reason is actually you are part of this small successful community of traders, or maybe you have been inspired by Mr. Alistair Crooks and really want to study much more and change for the better. Yeah, so you are either a part of this community, or you are going to become a part of it very shortly. Yeah, by probably being inspired by Mr. Crooks, for example. Secondly, you want to have quick profit. Yeah, like intraday traders, scalpers who want everything right now, today, not even tomorrow. If you want quick profit, this tool is not for you. And thirdly, you want to take decision yourself. So you want to decide whether you are going to trade Forex, whether you are going to trade futures, or you want to decide when you open, when you close. That's up to you. That's not a part of this product. So you will see it later. So if you want to take the decisions yourself, that's not your option. So the whole idea of this product is kind of represented on this page. Like kind of on the left, you see representative of broker, and on the right you can see the representative of client, like rolling together and trying to earn money together. That's the whole idea behind this product. But now let's move from the idea to more of details, how it works. And let me actually introduce you to the core principles. So there was an idea that long-term investments in top stocks are generally profitable. If you go to a portfolio of many famous American traders, they mostly invest to US stocks, and they are probably the big overwhelming side of their portfolio is actually stocks, and they are generally profitable, and they are not mainly trading on short-term markets, so they are rather long-term traders. So, and we had to find the most profitable and still reliable instrument. And the other principle, that the broker should not earn anything on spreads, on swaps. The broker should earn commission only if the client earns. And that's why the product is actually called on your side, because if you don't earn money, the product doesn't as well. So that's how it works. Now, let me introduce you S&P 500. I am sure most of you know about this tool very well, but if you don't, for example, if you traded all your life with just Forex, let me give you a very short introduction of this product. So this is a stock market index of 505 largest US companies. I'm sure you know all the companies you see right now on the screen, like Amazon, Apple, Microsoft, Alphabet, which is Google actually, yeah, JP Morgan Chase, Berkshire Hathaway, and that's Berkshire Hathaway actually belongs to Warren Buffett, Tesla, and all the else. What is more important is that the index was founded in 1957, so about what you call it, 75 years before, and it's growing since that time till now. So let me show you two figures. So this is a historic chart. It starts from it starts from 1928. Actually, it wasn't S&P 500. There were just a couple, maybe 30 companies from the start, and till actually 2017, and you can see how it's growing. You also can see that there were some downfalls. The first downfall was in the beginning of this millennium, yeah, on the beginning of 2001, with this crisis of dot-coms. And second downfall was actually 2008, very famous American housing crisis. Maybe you have seen the movie Big Short about this crisis. If not, I wholeheartedly recommend you to watch it. But even this, even if you would invest to S&P 500 at the very first time, at the very worst time, I'm sorry, at the beginning of 2008, it would took you to wait for about 3 years to get it growing until until 2015 you would have quite a lot of profit. And now let's watch to actually more modern chart. Here it is. And again, you can see the problems of 2020, yeah, the coronavirus, where the economics has really fallen down. But even after this, it took this index just 4 months to get back, and now and it's now growing heavily with improving statistics on coronavirus in USA. Yeah, just about 10,000 people daily of new cases, comparing with 200,000 actually in the beginning of 2021. So that's actually quite reasonable time to start thinking about S&P 500. So now let's talk about the technology. This picture is not a mistake. It's for reason. If you have any friend which is a veteran of trading, who is at least 50 years old and who is trading since 80s, and if you ask him, how did you start? He would tell you, well, you know, I had a broker and I took this phone, just the same phone as this lady has. I called the broker and I told him, buy this or buy that. So I know lots of these stories, and this is a kind of back to classic trading. So on your side, you are not opening deals directly. You can do it over the phone, in the mail, in chat, but actually it's opened by the broker, like it used to be before. The shortest period of deal is 3 months, so you cannot close deal earlier. Yeah, and if you look at the chart, you could actually understand why the real profit is actually usually done at least within half a year. So it has nothing to do with short-term investment, and that's why I said that there is no sense at all for the short-term investment. If you are short-term trader, this tool is definitely not for you. They have very conservative and fixed leverage of 1 to 5. It's small, but it's still very important, and that's why it makes sense why you shouldn't go directly to stockbroker, because there you will have to use 1-on-1. Here it's 1-on-5, so it's still 5 times more chances to get the profit. And what is more important, you can see it's very kind of undemocratic, so you don't really have the choice. So we believe that Instaforex has provided a very good tool. So the trader the only decision the trader takes is actually if he wants to go to this, if he wants to invest, and when does he want to stop investment. Yeah, in 3 months or in 6 months. That's how it works. The rest is done by broker. The broker chose the tool for him, which is S&P 500. The broker opens the deal, the broker closes the deal. And that's actually the whole idea, to be profitable, reliable, and very conservative. So that's not a scalping tool, that's just a tool for the long-term investor. So the 2 last slides. We decided to think what would happen if investor would invest $10,000 in 2017 if this product has existed before. So here is how it works. So in the end of 2017, he would have 11,000. As you can see, there were 2 problematic periods: the beginning of 18, the end of 18, and finally the worst period, the first quarter of 2020, the coronavirus. And as you can see, it always goes back. And if you would have the leverage of 1 to 500, that would be your balance today if you would start investing in 2017. So, and this is actually the quarterly profit you can see. So that's actually how it works. So so by the way, I think that's very clear to understand that normally it should take at least half a year to make the real investment. Yeah, because anytime you can have something like this, but in the end, it always goes back. So that's actually the whole idea of this. But there is one important question: how broker makes money? And let me answer. And there is also another question: how our wonderful IBs can earn on this. So that's very simple. Our commission is 25% from the profit of the client. So if client makes a profit of 1,000, we take 250, and we don't take anything else. No spreads, no swaps, nothing. Just 25% from profit. If client doesn't earn, we don't. And regarding this 25%, we share 50% of our profit with IBs. So the whole philosophy is kind of anti-CPA. I am sure we have some IBs here and they know about the CPA. Yeah, when you bring a client and earn some money for the first deposit and don't earn anything. Here, the philosophy is totally different. We expect the client to keep investment for a long time, earn profit, withdraw profit, and try to keep investment because it works. Yeah, because it has been working since 1957. So why not to continue this? And from every profit, the IB takes 50% from our profit. So that's how it works. So that's a kind of maximum loyalty. We are trying to offer the most reliable tool we were able to find on the market. So so that's a kind of opportunity to build great relations between the IB and the client. So guys, that's how it works. Thank you very much for your attention. I will read all the questions you have asked, and maybe I will ask the team of ShowFx World to let me answer these questions on the Facebook page. In case you are interested, and in case you want to get some special offers, see this mail. Make sure you have this mail and write us, and we will be happy to answer you and give some more feedback and maybe provide some special offers to this new tool. Okay, guys, that's about it from me. And now probably the most interesting part, the quiz and the good prizes. Let me go back to this topic. I am sure there are some people who are the first time. This is going to be your first quiz. So guys, first of all, let me explain you the rules. The rules is simple. First of all, when you write, when I provide the question, you must answer within 2 minutes. The winner will be who answers the first. The first correct answer is the winner. And make sure there are 2 options. The first option, you actually write to webinar hosts, and secondly to all panelists. We will qualify only the answer to all panelists. So make sure you are not writing to webinar hosts only. Make sure you write to all panelists. So that's how it works. So what I'm going to do, I will try to find out who gives the first answer, and if there is a correct answer, we will move to the next question. If there is not, I will try to help you, and you have 2 minutes. If there is no correct answer within 2 minutes, I move to the next question. So first of all, let me start with example. The example will not be a real question. Yeah, no prizes for it. It's just an example for the newcomers to understand how it works. So guys, I'm sure it's now everything about football, the European Championship, now quarterfinal stage. So the test question is not about finance. All the real questions will be connected to finance, but test question is not. So the question is, Which team was the first ever to win the European Football Championship in 1960? You can try to give the answers, but let me explain the logic. There are two ways how you can answer. The first way, you can actually know it. Yeah, you may love football and you know who actually won in 1960. Secondly, you might not know who is the right question, but you can watch at the picture, which is a kind of hint to the right answer. There is no right answer, by the way. I don't see any right answer. There is more or less right answer, but not exactly correct. No, I don't think Cristiano Ronaldo did actually exist in 1960. So far, no right answer. Let me give you a hint. The answer Russia is more or less correct, but yeah. And I see the right answer from Mohd Hakimi. That's USSR. And actually, what you see on your screen is actually the picture of Arnold Schwarzenegger from the movie which is called The Red Heat, where he plays the Soviet policeman Ivan Danko. So that was an obvious hint to the Soviet Union, especially for me, for people who really like some old movies. So guys, if you my question to newcomers, do you understand the logic? If everything is clear, please write, and if you're newcomers, please write yes. But the logic, okay, I see a couple of yeses. Thank you so much, guys. And now we go to the real question. It will be quite easy. The first question is, so the right answer is USSR, as you understood. And now the first question. The price is for 1,000 USD bonus. All profit is withdrawable. So here we go. So after the financial crisis of 1997 in South Korea, its abbreviation was jokingly treated as "I'm fired." Please provide its correct full name. There is no right answer, but I would like to thank Mr. Terence Wong for incredible wrap-up of my presentation. Guys, I am fired. So this is joke in abbreviation. So you have to think about the real. Okay, I see the right answer. I see the right answer. I'm not sure who was the first, but I see that the right answer was given, so I can share it with you. Actually, what you see on your picture is Washington, D.C., and this is the headquarters of this place, and this is International Monetary Fund. So my congratulations to the one who was the first one. I'm not sure who. The ShowFx World team will share it on their Facebook page. And now we can move to the second question, which is, to my mind, just a bit more complicated, but really not much. So this is for the bonus $2,000. So the European currency euro replaced a lot of national currencies. The less valued among them was Italian lira. What was the most valued and which costs with cost over $1? Okay, there is no right answer yet. At least I don't see it. GBP that still exists. So this currency doesn't exist any longer. And there are really a lot of hints to this country on your on the right of your screen. Really lots. Beer is a good, shamrock. Actually, everything is green in green color. At least maybe there was a right answer, but I don't see it. Probably there wasn't. So I'm still waiting for the right answers. You still have about 1 minute. Oh yeah, I see the right answer. I see the right answer. I'm not sure again who was the first one, but there are quite a lot of right answers. So guys, let me explain again. The beer, the shamrock, the green color, that all obviously hints to the Republic of Ireland. By the way, great place to be. I spent a lot of time in my when I was a student. Great country to be. And the answer is Irish pound. Yeah, so actually correct. My congratulations to the winner. I'm not sure who was the first, but I'm sure the team actually is actually searching and was able to find out who is the first. Make sure you are joining the Facebook page of ShowFx World. And finally, the most difficult question with the best price. So guys, here I think the question is quite hard. So good luck to you. So in one of the articles devoted to it, the author says that Indian rupee is too rare. Name it. Yeah, the question is quite difficult, and I'm starting to actually watch the and I will qualify only the full correct answer. So far there is no right answer. So far there is no. Yes, guys, I know that you see that this is a Mac, but look, it's a question for iPhone. It couldn't be so easy. This Mac should hint to something. So I'm sure. And again, Indian rupee is too rare, so that somehow should be connected with Indian rupee. And why it's too rare, and why the word rare is actually highlighted with bold. So rare is actually the key word. So far, I don't see the correct answer. Maybe there was. You still have a minute for the right answer. And rare is actually a very interesting hint. So there is one hint which is Mac, and second question which is rare. And you should try to somehow make them together. Oh, there is a very close answer, but not exactly correct. There is very close answer in chat, and you can actually, you still have half a minute to give fully correct. Wow, and we have the winner. We have the right answer. My congrats. I'm not sure again who was the first, but we have the winner, and my congratulations. You have just 10 seconds before the deadline and you manage it. My congratulations. So let me explain the logic. Here you can see, as you correctly pointed out, the Mac. Okay, now Indian rupee is too rare. You know that rare has two meanings in English language. The first meaning is something which doesn't happen quite often. But secondly, that's about the level of roast of the meat. Yeah. So it can be like rare, it can be medium, it can be well done. And when you think about the Mac and about the meat, you can think about the Mac in terms of McDonald's, yeah, Big Mac. And there is a Big Mac index, which actually is one of the important index for economists. So there is a genius which is actually was in the chat who managed to give the right answer, and that's Big Mac index. Guys, I hope that was interesting. Again, it seems, thank you very much for your attention. It was a pleasure to host you, and I see Anna, who looks like she's ready to join us. Anna, the stage is yours. And guys, thank you very much. It was a pleasure to be with you.
Guys, thank you, Pavel. And guys, I wanted to thank you for participation. I know it's too late for many of you, and you wrote that you are sleepy and you want to go to bed. So now it's the right time to do it. Thank you so much, guys, and we'll see you at our next webinars. Thank you. Bye-bye.